Ind AS 12 income taxes. So this is standard talks about completely, my dear friends, about why income tax has to be created as a every year as a provision for income tax. That is why it has to be treated as a provision. So because income tax is a period related expenditure, that is for that year income tax. So Aarti, can you mute it? Yeah. So for that year income, you have to pay the tax on that year itself. So therefore, it is benefit was generated and consumed in the same year. That means it should be treated as an expense because we can't postpone also. Yeah. So therefore, it is to be treated as an expense. So then the reasons was stated for why the difference has been emerged. Why the difference has been emerged. Then we come to know the reason that so there is a difference between a treatment between accounting provisions as well as income tax provisions. So because of this difference between two act or two provisions, so the difference will emerge. Such difference has been classified into two types. One is permanent difference, another one is timing difference. Yeah. So permanent differences are it will emerge and it will never reverse in life. Yeah. It will be like two parallel lines, a railway track. So it will never intersect. Got it? Yeah, how long you wait, so it will not intersect. So therefore, those things what we call it as permanent difference. So because of permanent difference, your tax liability will not alter. So therefore, they are kept outside the scope of Ind AS 12. Outside the scope of Ind AS 12. So then, other type of difference is, second type of difference is timing difference. Timing difference means it will originate and it will get reverse in future. Understanding that? It will originate
Yes.
and get reverse in future. Yeah. So that means it will originate and it will get reverse means. So in the year, 1 year it will originate and next year onwards or subsequent in some years it will start to reverse it back. So such differences are taken into consideration. So such difference may be result in two types. One is either currently where you have to pay higher tax, their savings in tax has been occurred. So because of this, in future your tax liability will increase. So expected to increase. So such a situation, what we call it is that is currently savings. In future, if it is expected to increase, then it is called as deferred tax liability. Yeah, in the same way, in the future, suppose currently you have to pay less tax, but as per tax you have paid high. As per tax provisions, you bound to pay currently higher tax, but because of this, your future tax is expected to reduce. Got it? So such situation will be resulted in deferred tax asset, that is currently higher tax. In the future, your expected tax is savings. So this deferred tax asset you have to create with highly caution that if it is highly probable that in future, if you could able to reverse the deferred tax asset, then only, that is if you could able to reverse this tax, then only you can create deferred tax asset. Otherwise, even though deferred tax is situation is there, you have to ignore as per conservatism concept. Currently, suppose you have savings in a tax, and in future, because of that, if the expected tax liability will increase, then it will result in deferred tax liability. Correct? Huh? So that a liability. So since it's a timing difference, 1 year it has to be originate, and in subsequent years it has to be reverse or not. Yeah. On origination it is called as deferred tax liability, and on reversal it is called as reversal of deferred tax liability. Yeah. Next, in suppose if currently savings is there, because of that in future, if it is expected that the tax liability will save, then it is resulted in a deferred tax asset. So for that, in the year in which the difference is originated, it is called originating deferred tax asset, and in future when it has got reversed, then it is called as reversal of deferred tax asset. Got it?
AS 12. So what is tax expense formula? Tax expense formula. So tax expense is equal to, my dear friend, current tax plus or minus. So current tax plus deferred tax liability or minus deferred tax asset. Are you understanding? What is the formula? Yeah, as per AS 12. So current, tax expense means what? Tax expense formula is what?
Current tax plus or minus
Yes.
deferred tax
Yeah,
asset or liability.
now correct. Sir, current tax means what? Current tax means what? Current tax means, my dear friends, current tax means the amount of tax paid in current year. What is current tax means?
The amount of tax paid in current year.
Correct, Arshita. So current tax means it is, so amount of tax actually paid in current year as per income tax. Are you understanding? Actually paid or liability. What is for this year, what is as per income tax, what is liability, that is what we call it as current tax. Are you understanding?
Yes, sir.
Yeah. So then profit as per accounting, that is a difference. So here, why the difference will come? The deferred tax is nothing but what? Deferred tax is difference between accounting profit and tax profit. That's what we call it as tax base. Deferred tax means what? Yeah, deferred tax means, my dear friends, it is a tax on accounting profit, difference between tax on accounting profit and tax on tax profit or taxable profit. Tax on taxable profit. So this is the difference. So if that difference is savings in current tax, but in future it is expected to increase, then it is called as deferred tax liability. And currently there is a excess tax I paid, but because of this in future, if there is a savings in a tax, then I call it as a deferred tax asset. Understanding that? Guys, slowly, are you understanding?
Yes, yes.
Yeah. So if you have any doubt as of now, kindly let me know. So that means, sir, why this difference will come? Look out. As per accounting, profit we will calculate. That is the books of accounts we will prepare. So in our accounts, we are studying which subject? Which subject we are studying? Financial reporting. That means it is a accounts, correct?
Yes.
So in accounts, I am passing entry means it should be based on accounting profit. If I am not correct, if I am not wrong, correct?
Yes, sir.
Yeah. So therefore, I supposed to pass the entry on my accounting profit. So therefore, look out. Even if you see, my dear friend, cash or bank balance, even though bank balance is different. So we are preparing bank reconciliation statement, and we will take balance as per cash book or books of account in your balance sheet. Yes or no?
Yes, sir.
Yeah. So for that we will give explanation. So why it is different between our accounting as per book as well as bank. Yeah. If I take as per bank, my balance sheet will not tally.
Yes.
I want as per book, what is the bank. So now auditor will come and ask why the difference between your bank balance, what you have disclosed, and in a bank statement when we taken the evidence as per SI 230 documentation. So there is a difference. Correct?
Yes.
So now he will ask why, what happened, why is the difference. That time the accountant or manager has to give the explanation. Look out, as per accounts we are correct. So because of this reason, so in a bank this balance is affecting. So that reason they have to quantify or not.
Yes.
That is what BRS. So like that here, as per accounts, the tax what you have to pay is correct. But computation of liability of tax is as per accounts, but actual payment is as per income tax. Are you understanding?
Yes, sir.
Yeah. So that's where the difference will come. Are you understanding, Pramod? Slowly.
Yes, sir.
Yeah. Liability is as per accounts, but payment is as per.
Tax.
That's why the difference will come. Are you understanding slowly?
Yes, sir.
Yeah. So computation is as per liability. That is a tax liability. Tax liability is as per accounts. As per accounts. This is what computation, correct?
Yes, sir.
Computation. But payment. But tax payment is as per tax provision. Tax provisions means what? Income Tax Act. Are you understanding?
Yes.
Therefore, difference will emerge. Are you understanding why that difference will come?
Yes, sir.
Yeah. So now, my dear friends, now you're all nice kids, you know. So therefore, now since you understood this much of insight relating to deferred tax liability, deferred tax. Now let us go to analyze. I said the difference which will originate is due to accounting profit as well as taxable profit. Correct? The taxable profit, what we
Yes,
call it
sir.
as tax based in a gross amount on that tax. So here, this story is only tax amount difference, my dear friend. Are you understanding?
Yes,
Yes, sir.
sir.
Yeah. So now that difference, whatever the amount differences are raised, that is either due to permanent difference or temporary difference. If it is a permanent difference, it is out of scope. There is nothing to discuss in this standard. It is out of. Second one, if it is a timing difference, means it will originate and it will reverse in future. Correct?
Yes, sir.
Yeah. Now, at the time of originating, suppose what is the nature of originating? It has got birth. So that means that originating transaction was resulted. Currently, I have to pay higher tax, but there was a savings in tax. So because of this, there is a future expected to increase in tax liability. Correct?
Yes, sir.
Yeah. So that means as per accounts, I have to pay higher tax, but as per income tax, they said no, 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 you have to pay this much tax sufficient for this year. Correct? So therefore, there was what's like scared or panicness inside our heart or mind. So why? Because as per accounts, I have to pay more here, but income tax is saying no, you have to pay only less. That means in the future, my expected tax liability will increase or not? Because it's a timing difference. Currently savings means in future it will increase. Correct?
Yes, sir.
Yes.
That situation, what we call it as deferred tax liability. That is current year tax we have postponed to future, therefore deferred, postponement. Yeah. Next, in the same situation, so that can be on in the year in which it has been originated that a difference was emerged. That is called as originating timing difference. In our case here, in the first part, it's a originating deferred tax liability. Correct? Fresh.
Yes, sir.
Thereafter, in the future, what will happen? It will get reversed. So that is what technically we call it as reversal of deferred tax liability. Correct?
Yes, sir.
Yeah, like that. Alternatively, current year, suppose if the tax where I have to pay less, but income tax department said no, 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 this is deductions and all not allowed. Therefore, as per tax, this is the taxable profit. On that, you have to pay this much of tax. So the tax is higher. Where I have to pay less tax, their income tax department asks you to pay higher tax. Correct?
Yes, sir.
So because of that, what happened in my future? My tax liability is expected to reduce or not?
Yes, sir.
Correct? So that's what technically what we call it as deferred tax asset. Yeah, so it is expected savings in future. So for that, conservatism concept has to follow, because in future you are believing that your tax will be saved. It is anticipated gain or not?
Sir.
Yes.
Therefore, there should be highly probable that in future you are going to the income, and as per income tax provision, you have to pay higher tax. There, that savings has to be affected. If you are expecting that certainty, then only deferred tax asset can be created. Otherwise, deferred tax asset, even though if it is there, you have to ignore. Are you understanding?
Yes, sir.
Correct? But deferred tax liability, left to right, you can recognize. Got it?
So,
Yeah. So now, as per Ind AS 12, my difference, the formula. So tax expense, it is not provision for tax. That is what the mistake. All these years you were passing the entry as provision for tax, provision for tax. But as per Ind AS, it says that so if it is applicable to corporate, so therefore don't pass it as a provision for tax. So call this as a tax expense. Understanding that? Yeah, we will not pass the entry as provision for tax. We will pass the entry as it is a tax expense itself. So tax expense formula is current tax, that is as per income tax what you paid. So plus or minus deferred tax asset or deferred tax liability, because we have to pass the entry in books of accounts. That means for accounting, for the tax as per accounts only, we have to book it. Yes or no? Yeah, in that split. So payment is as per current tax, but accounting is as per accounting profit. So that's why the formula is tax expense is equal to current tax plus or minus deferred tax liability or deferred tax asset. Got it?
Yes, sir.
Yeah. So now, so Kishan, are you fine with this?
Yes.
Yeah. Now let us go it to take the illustration relating to deferred tax liability. So how it will work. So with this illustration, my friends, I promise you will get a little clear idea. So for this standard, at least you should possess the knowledge relating to PGBP income in your income tax. Got it? Completely. PGBP income. So if you know that PGBP income of provisions, so from section 28 charging to section 44, till that section, suppose if you know, at least up to 36 and disallowable expenditure, so 40, 43, 43, up to that, suppose if you know that expenses, so then we can smoothen this standard can be complete. Got it? Deferred tax liability. So now, my dear friends, first I'll give time, please concentrate. I'll give time, please concentrate. Now, let us go into this is a particulars and year 1, year 2, year 3, year 4 and year 5, Y5. Yeah. So imagine these are 5 years. Now, let us go, my dear friends. Net profit. Net profit. So as per accounts, so this is before depreciation. Before depreciation, let us make this is 100. 100. Are you okay with as of now?
Yes, sir.
Yeah. So this is as per books of accounts. As per books of accounts. This is the net profit. Correct? Huh? So on this only, actually, you have to pay the tax or no? Yes or no?
Yes.
What profit you have earned as per accounts, on this only, actually, you have to pay the tax. Correct? Huh? Let us make here. So depreciation less depreciation. So cost is equal to 100. So useful life is 5 years. 5 years or 20%. So every year 20 is depreciation. Yes or no? 20 is depreciation. Correct? Huh? So therefore, what is a taxable accounting profit?
80.
Accounting profit. It is 80, 80, 80, 80 and 80. Correct? Huh? Now let us go as per now. So depreciation as per income tax. As per income tax. Have you come across a 35 AD? 35 AD or 35D scientific research?
Yes, sir.
Yeah. So therefore, so cost is equal to 100. So 100% depreciation in year 1 itself. Are you understanding?
Yes, sir.
So 35D. Got it? Scientific research. Either 100%, 170, 150%, 200% depreciations are there or no? Yeah.
Yes, sir.
So imagine here 100% depreciation in first year. So that means first year itself how much? 100. So next year onwards,
Then
are you understanding? This is on the same. As per accounts, you will claim it is not in a 1 year itself. Directly, as per accounts, it is a 5 years life. Therefore, 20, 20, 20, 20 in a gradual manner, you will claim. Yeah. But as per income tax, what happened?
first year whole depreciation.
Yeah. So then first year itself complete 100% is allowed. So in the future, it is not allowed. Understanding that?
Yes, sir.
Yes, sir.
Yeah. Now, my dear friends, so because of this, what is a taxable profit?
Zero.
Taxable profit as per income tax. So it is nothing but what is the sequence? What we have? Wait, let us give the number 1.
First year, 0.
Yeah, 1, 2, 3, 4, 5. So 5 is nothing but 1 minus 4. Correct?
Yes, sir.
Yeah. Can you give me Akshata? What is the figure?
0. First year, 0.
First year is nil. Thereafter
100,
100,
100, 100.
100, 100, 100. Correct?
Yes, sir.
Yeah. So that the difference, what we call that 80. So this for this difference, what we call it as a tax base. Are you understanding? Tax base difference. Difference between that and this is called as tax based difference. Are you getting the slowly control?
Yes, sir.
Yeah. Now let us go with so tax liability. So sixth one is, let's go as tax at commonly let us go with 30%. Tax at 30%. First let us go on accounting profit. Accounting profit. Correct? So if I'm not wrong, what is that? So accounting profit is 3 na. So
80.
3 into 30%. So therefore 80 into 30%, it is 24.
Yes, sir.
Yeah. So standard talks about tax liability only, my dear friends, not amount. Are you clear?
Yes, sir.
Yeah. First you have to compute the amount difference. On that you have to apply tax rate. Then only you will get tax difference. Correct?
Yes, sir.
On difference, if you apply what is the tax amount, you will get what is the tax difference you will get. That difference, if it is a savings in currently, then in future, if it is expected to increase, then it is called as what? Deferred tax liability. In future, currently, if there is an increase in tax, there is a higher tax we paid. In future, if it is expected to decrease, then it is called as deferred tax asset. Clear? Yeah. Now let's go on taxable profit. Taxable profit as per income tax. That is column number 5 at 5 into 30%. Yeah. Which amounts to first is nil.
Yes, sir.
Yes, sir.
First is nil.
Then
First
30.
is yeah nil. First is nil. Then is 30, 30, 30, 30. Are you understanding, my dear kids?
Yes, sir.
Yeah. So therefore, net what happens? First, let us see. First, student is jumping like anything. 24 is savings. Correct? It's a positive. 24 is savings. Correct?
Yes, sir.
Yes,
But
sir.
thereafter, what happens? Yeah, net effect you have paid 6 rupees. That is as per accounts what you're supposed to pay. Beyond that, 6 rupees extra you paid or not?
Yes, sir.
Correct? So this is what we call where I supposed to pay. This is what actual liability. This is what liability, but this is what payment. Are you understanding, Arti? This is what?
Yes, sir. Now I am able to understand, sir. Clear,
That's
sir.
why if you give time, everything I will cover. Only thing you
Thank
have
you,
to
sir.
allow me to speak. That's what the problem. Yeah. Now look out. First year when it is look out where actual liability I supposed to pay 24 rupees. But how much I paid?
Yes, sir.
How much I paid? Nil. Income tax said no. As per our provisions, so you don't need to pay tax. So therefore you are jumping like anything. I saved the tax. Correct?
Yes.
Yes, sir.
But I said array wait. Yeah. So in the future, check out what happened. In future, what happened?
You will have to pay.
Yes, sir.
Where you have to pay only 24, there you have to pay 30. That means income tax department indirectly they will collect or not?
Yes.
Yes, sir.
Yeah. So therefore, this first year when 24 rupees you saved, so don't jump. That is called as originating deferred tax liability. Originating timing difference. Are you understanding?
Yes, sir.
Originating deferred tax liability. Correct? So in the future, this 66 rupees minus what is there, this is minus 24 what is there, this is what reversal of deferred tax liability. Are you understanding slowly?
Yes, sir.
Yes, sir.
Yeah. So therefore,
Yes, sir.
so the moment if I say this, students are expecting journal entries for this or not? Yes or no?
Yes, sir.
Yeah. So therefore, first, this is for deferred tax asset. Number 1 on originating deferred tax liability. Correct? This is what recognition. So this is liability, therefore we have to credit it. Therefore entry is profit and loss account debit to deferred tax liability account. Are you understanding? In our case it is 24. This is year 1 when it is generated. Yeah. Next, second entry on reversal of deferred tax liability, it is nothing but opposite entry, my difference. Deferred tax liability account debit to profit and loss account 6 every year. Every year till completely written off. Are you understanding? Let's go for deferred tax asset now. So same example, same illustration. Let us go for case. Now part 2. This is deferred tax asset. Deferred tax what? Asset. Now, so in case of deferred tax asset, my dear friends, let's go with the same presentation particulars. So year 1, year 2, year 3, year 4 and year 5. Now for this year, let us go with accounting profit. So profit as per books, that is accounting profit. Let us take example 100. Yeah. Next, here let us take the example of preliminary expenditure. Have you come across?
Yes, sir.
Preliminary expenditure under section 35. Preliminary expenditure. So here 100% deduction in year 1. So as per Ind AS 30, Ind AS 38 intangible asset or AS 26. Are you understanding? Yeah. If preliminary expenditures has been incurred, so whatever amount, suppose if it's a research stage, etc., or company for incorporation, etc., if you would have incurred, so that governed by intangible assets. So as per that section, para 56 of AS 26 clearly says that it has to be charged off completely in the year in which first year when the financial statements are prepared.
First year.
First year. Are you understanding? Yeah. So as per accounts, as per accounting standard, we have to follow. So therefore, as per such accounting standard, 100% we have charged to first year. Therefore, what is the profit? Net profit as per accounts, it is nil. So then 100, 100, 100, 100. Yeah. So then, so this is third. Fourth one. So preliminary expenditure. Preliminary expenditure as per income tax. So it is whatever 100 is there, it is divided by 5 equal installment.
Yes, sir.
Yeah. So it is allowed in what? Preliminary expenditures is allowed for deduction in 5 equal installment. Are you understanding?
Yes, sir.
Yeah. So you would have come across final students. So therefore, I don't have the right to speak with you guys also because you are well ahead than me. Because I'm stipulated or restricted only to my subject. That's it. That is what my job. Beyond that, really, I don't know anything. Yeah. So preliminary expenditure. So here, how much is reduced? How much is allowed for deduction?
20 rupees.
Yeah. So that is the first year 20 is normal. Balance 80 is originating timing difference. Yeah. Look out my difference here. 100 I charged. So out of 100, 100 here deducted. Here 20 deducted. That means to the extent of this 20, 20, no difference. Yeah. What is the difference? 80. Friends, are you understanding?
Sir, ಮತ್ತೊಂದು ಸತಿ ಹೇಳ್ರಿ.
So just imagine here 100 rupees is a preliminary expenditure charged, 100 rupees deducted. Yeah, out of that, in tax 20 rupees deducted. That means out of 100, to the extent of 20 rupees, there is no difference between accounting and tax. Correct?
Okay.
Only difference is that extra 80 rupees which has been allowed in income, allowed in accounts, and not allowed in income tax. That is the difference. Correct?
Okay.
Are yes or no, yaar?
Yes, sir. Yes.
If it is this 20 rupees also not allowed as a deduction in income tax, means total 100 is difference. But here, for
Yes,
example,
sir.
50 rupees is allowed, means balance 50 rupees not allowed, means the difference is, timing difference is only that additional 50 rupees which is not allowed, no?
Yes, sir.
Yeah, so like that here, 20 rupees is allowed as a deduction. Therefore, out of 100, 20 to the extent of 20 rupees, there is no difference between accounting and tax.
Yes, sir.
So only difference is balance 80 rupees. This is what originating timing difference. Understanding that?
Yes, sir.
Yes, sir.
Yeah, keep in mind. So now let us go. What is the fifth one? What is the taxable profit? Income tax, as per income tax. It is
It-
column number 1 minus column number 4, which is 80 na?
Yes,
Yes,
sir.
80. Next. Sorry. No. Oh yeah, 80, 80. 80, 80, 80, 80. Yeah. So now this is what my profit, taxable profit. Now let us go for tax computation. Tax liability. Tax at 30%. Example, if I take now. So first one is
On
what?
accounting profit.
Yeah, on accounting profit. First is nil,
Yes, sir.
nil. Then 30, 30, 30, and 30. I supposed to pay.
30.
Correct? Yeah, but
Yes, sir.
on taxable profit, income tax, which is 24,
20.
24, 24, 24, 24. Correct?
Yes,
So
sir.
therefore, what is a net? What is net?
First
So in
year
the first
is
year, it is
minus 20.
minus 20.
where I have to pay nil tax. There we have to pay how much? 24. Correct? So therefore, Akshata is crying or not?
Minus 24.
Yeah,
Yes,
Akshata is
sir.
crying or not? Yeah, tax.
Yes, sir.
Yeah. So but next year,
ನಾನು ಕೈಲೇ
yeah.
ಕೊಡ್ತಾ ಇದ್ದೀನಲ್ಲ.
Pocket in the ಕೊಡ್ತಾ ಇದೆಯಲ್ವಾ ಕಂದ?
Yes, sir. Yes, sir.
Yeah. So next, like one of the student, Chingalala, correct? Look out, saving 66666. Got it? So first year it is like negative, minus, but thereafter it is completely, it's a positive.
Yes, sir.
Yeah, look out, where you have to pay 30, there you have saved 66 rupees. That is a subsequently it has been reversed or not? The difference what you thought, it is nothing but, so on what I said, timing difference, 80 rupees is a difference into 30%, which is 24 is a timing difference. Correct?
Yes, sir.
Amount difference is 80. On that, tax only our concern, not the amount. Got it? That tax difference, what we call it as difference in tax base. That 80 rupees, what we call it as difference in taxable profit. That is what we call it as tax base. Understanding? So here what we call it this as plus 24 savings, plus 24 savings. So this is at the time of creating that negative, it is called as originating deferred tax asset. This is called as reversal of deferred tax asset. Are you understanding? Yeah.
Yes, sir.
So, but at the time of creation, you should be very careful. There should be certainty that in future it will get reversed. Are you understanding? Note, on creation, on creating or recognition of DTA, it should be certain that in future, it should get reversed. Yeah, if probability is less than DTA should not be recognized. Should not be what?
Recognize.
Should not be recognized. Are you understanding slowly, Pramod?
Yep.
Yeah. Now let us go to the entry. So here, so this entry is nothing but, so on creating DTA, so it's a deferred tax asset. Suppose if it's a probable that you are going to your chances of reversing is more, you are creating that, you are believing that. So therefore entry is deferred tax asset account debit to P&L account 24. This is I'm sorry, on recognition of DTA. Next is on reversal of DTA, on reversal of DTA, on reversal of DTA, it is a reversal entry. So P&L account debit to DTA account 6 on reversal of DTA every year. Are you understanding?
Yes, sir.
Yes.